Most mergers and acquisition transactions in the marketplace are based on EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Why? Well, the industry needed a level playing field. They needed to sort of take a company and strip out company-specific expenses like interest and depreciation and add those expenses back into a number so that they can level the playing field and compare that company to its peers in an industry. The problem becomes as when you're doing an acquisition and you're looking at EBITDA as your main financial metric based on which you offer a purchase price, you could be dipping into your pocket if you're not careful. And so I'd like to tell you a few things that most advisors won't. So the first is that EBITDA completely ignores working capital. What am I talking about? Working capital is receivables, payables, inventory, and accruals. So if you're in the high growth industry and you have a lot of capital expenditures, you may be borrowing that money in future years because the EBITDA is not going to take that into account. Number two, EBITDA creates a facade around how much cash is available. So let me give you a real example. You've got a company that you're buying. It's got $1 million in profits. It's got $1 million in interest expense, and it's got $1 million in depreciation. Let's add the $1 million in profits and the $1 million in depreciation together. You've got $2 million, and you've got to service $1 million in interest expense. So the facade is that you've got $2 million to service $1 million of the debt. But the reality is depreciation is a non-cash expense. And so at best, you'll be at a break-even position or worse. So you really, if you're basing everything on EBITDA, truly you need to think again. Third, that EBITDA does not give you a good view into what the real quality of the earnings of the enterprise really is. And a classic example is that this would be that EBITDA ignores or does not measure unrecorded liabilities, off-balance sheet liabilities, under-reserved liabilities. So things like accrued vacations, taxes in many cases, or especially if they're being accrued. So it could be that you bought a company mid-year, you didn't take this into account, and bonuses are due at the end of the year, and you should have gotten 6 months worth of accrued vacations or bonuses money, and now you're having to lower your profits to service your obligation. So, which is another reason why you need to have working capital adjustments in your purchase and sale agreement, because this will rectify that. Rare Brain Capital helps companies improve performance and sell for maximum value. How ready is your company to grow or to sell? Want to know how you're doing? Get your free score plus customized report in just a few minutes at no cost or obligation. Visit rarebrain.com/score.